All right, hey everyone, welcome back to the Uncrypted Crypto channel. I'm your guide, Warren Alcon, and today we're finishing up the third class of candlesticks. Let's go. Now, with there being about 150 different candlestick patterns, you can already guess that candlestick mastery will take some time to get a thorough grasp of. Now, I've been over the top 35 candlesticks over and over, and I've come to believe that memorizing these candlesticks isn't altogether necessary for the beginner trader. The important thing to grasp as a beginner is the psychology of candlestick formation, especially as they approach key areas of support and resistance. Now, building on what we discussed in the previous class, the key is to memorize the process that forms these candles, understanding the why behind each one. Now, the candle patterns that we'll be learning today can form on any time frame, but just as I've said before, for beginners, let's keep things simple. It takes a lot of practice to navigate very small time frames. So for now, let's keep it within our main three. So, the three groups of candles that we're going to cover today are bullish reversal, bearish reversal, and indecision candles. Okay, first up, we've got bullish reversal candles. These candles can be defined as a bullish momentum indicator. Now, here are some guidelines for bullish reversal candles. These candle patterns need to be formed in a downtrend. If not, then it's probably just a continuation pattern. Bullish reversal patterns require bullish confirmation. They must have accompanied trading volume. And they should be confirmed within 3 periods of forming. So if you're trading on the daily, it needs 3 days of confirmation. If you're trading on the hourly, 3 hours of confirmation. So the first style we have is a bullish engulfing candle. These are the easiest candles to identify. They're simply larger than the previous candle and, of course, are green. The smaller candle's body must fit inside the engulfing candle's body. So right here, we have our price closing. Now, once the next time frame opens up, you can see that the bears drove price down, but buyers came in, rallied, and took control of price action for the majority of the time frame, driving price up for the higher close. This should also be accompanied by matching volume. Next up, we have the hammer and inverted hammer, also called a shooting star. These are both signs of a possible downtrend reversal to an uptrend. Both are a color change from red to green. The body of the hammer candle is short with a long lower wick, which is formed in a downtrend. This is an indication of sellers driving prices lower during that time frame, only to be pushed out by strong buying pressure to end the session on a higher close. For the inverted hammer or shooting star, it's identical to the hammer except for the longer upper wick, which indicates buying pressure after the opening price in a downtrend, the wick up, is followed by considerable selling pressure, which wasn't enough to bring the price down below its opening value. Now, before we jump onto the bullish reversal action, however, we must confirm upward trend by watching it closely for the next few periods. The reversal must also be validated with an increase in trading volume. Now we have bearish reversal candles. The guidelines for bearish reversal candles, it's the reverse theory of bullish candles. So, bearish reversal patterns need to be formed in an uptrend. If not, then it's probably a continuation pattern. Bearish reversal patterns require bearish confirmation and have accompanying trading volume, and should be confirmed within 3 periods of forming. So first up, we have the bearish engulfing candle. Again, these are the easiest candles to identify. They're simply larger than the previous candle. Smaller candle's body must fit inside the engulfing candle's body. Next up, we got the falling star, shooting star, or the inverted hammer, which is identified by a small body and a long upper wick. A shooting star is formed in an uptrend and is an indication that price could start falling. It's a bearish formation because buyers tried to push the price up. Sellers came in and brought it down to the close of the opening level. If price rises after a shooting star, it may have just been a false signal. Finally, we have indecision candles. Indecision candlesticks are formed when both buyers and sellers create a near equality within the trading time frame. These patterns can be very rare, but when identified, some traders see them as reversal patterns, depending on their formation on swing highs or swing lows of price action and the direction of the wicks. So here's 3 quick types of indecision candles that you're going to encounter, and they're called dojis. And doji just means the same thing in Japanese. So we have the gravestone. It has a long upper wick. We have a long-legged, which is equal lengths and wicks, and a dragonfly, which has a long bottom wick. And they're just trend continuation candles as well. Next up, we have the falling 3. This pattern shows us that the bulls don't have enough momentum to reverse the current downward trend. The falling 3 is a bearish 5 candlestick pattern that signals a temporary interruption, but not a reversal of the current trend. This pattern is identified by 2 large-bodied red candles at the beginning and end, with 3 smaller green candles in the middle moving countertrend. Next up, we have the rising 3. It's the opposite of the falling 3. This pattern shows us that the bears don't have enough momentum to reverse the current upward trend. The rising 3 is a bullish 5 candle pattern that signals a temporary interruption but not a reversal of the current trend. This pattern, again, is identified by 2 large-bodied green candles at the beginning and end, with 3 smaller red candles in the middle moving countertrend. With the rising and falling 3, you can almost consider them to be very small pullbacks. So with that theory in mind, it can set us up for a late entry position. As with all candlestick patterns, you cannot rely on them solely to make a decision on a trade entry. All patterns require trend confirmation, and especially for us, confluence on multiple time frames. You can only make a sound decision when you weigh the facts. When you first get good at reading charts in lower time frames, be careful not to get stuck down there. It's easy to forget about the higher time frames and the established information they give us. So when in doubt, zoom out to confirm the overall trend direction. And before we move on, how are you liking the channel? Please like, comment, subscribe, and share this video to help support the channel. So let's get some homework going for you. Until the next video, we're gonna get you practice memorizing just these introductory candlesticks. See how many you can identify within our 3 main time frames. Based off of what you learned so far, see if you can spot any possible trend reversals that are nearing support or resistance levels that you drew out, both static and dynamic, and on multiple time frames. See what signals you're getting from our confluence checklist so far. We're checking support and resistance, chart patterns, candlestick patterns, candlesticks, everything checked out on multiple time frames. Always focus on possible long and short entry opportunities because it's all about multi-time frame confluence. Take notes. Always take notes. And guess what? You have just finished Price Action Basics, the first block in the Uncrypted Crypto Trading course. So congratulations on getting this far, because coming up in the next block are indicator tools. It's what everybody loves to check out. So be sure that you are comfortable with navigating the basics of price action before moving on. We'll see you on the next level.